Everywhere I look right now, on Google, on YouTube, and even people ask AI tools like ChatGPT, the same mortgage questions keep coming up. People are asking things like, how much can I afford? Are mortgage rates going down? Should I wait or should I buy now? And the problem isn't that people aren't asking good questions. The problem is they're getting completely different answers depending on where they look. So today, instead of guessing or predicting the future, I want to sit down with someone who works with mortgages every single day to actually explain how this works in real life. Vincent Newsome for National Mortgage Funding. Vincent, thank you for being here.
Thank you. Happy to be here.
Before we even talk about interest rates, I think a lot of people are missing the basics. Can you explain at a high level how mortgage actually works in real life? Not the textbook definition, but what people experience month to month.
So the textbook, even though you said not to give you the textbook answer, is a mortgage, though, is a loan that the bank gives you that they put a lien on the title of your home. So you own the home as well as the bank, and you make a mortgage payment every month. Now, the real answer of what a mortgage is to you is a payment that you are going to be paying every month that derives of principal, interest, property tax, homeowners insurance, and mortgage insurance.
But to go a little deeper, how does a mortgage interest work? Because I think a lot of people are shocked when they see how little their payment goes towards principal early on.
So how mortgage interest works, it's based solely on the loan amount. So an interesting fact, if you have a 30-year loan, let's say at 5.875 on 300,000 and a 15-year loan at 300,000 at a 5.875, the first monthly payment that you make on that loan, the interest is identical. So you'll be paying $14.68 in interest on a 30-year and $14.68 on a 15-year. Now you may say, okay, Vince, but the 15-year program, the payments are a lot higher. Why would that be the difference? Well, you're paying a little bit more principal on a 15-year than you are on a 30-year. And again, your payments derived of principal and interest. So how interest works, it's very based on the loan size. So as the loan size decreases, you pay less interest every month. That's why on a 15-year overall, you're going to be paying less interest because you're so principal heavy on the principal portion of your payment. So that'll decrease more rapidly, which means less interest. Where a 30-year, you're paying less principal. So the principal payment on the loan size is decreasing at a slower rate, which obviously increases the amount of interest you're going to pay on the life of the loan. So interest is solely based on your loan size.
Once people understand that, the next question almost always becomes, and this is probably the one that's most common that I see online, how much can I afford? When someone asks you that, what do you wish they were asking instead?
I love this question, and I get it a lot, especially when clients are first-time home buyers. They want to know, well, what's the overall purchase price that I can afford? The question that I wish that they were answering is, how much do you want to afford? So when I calculate out a monthly payment, we're looking at your overall picture. So I really like having a starting point, because most times when people are coming to me, they already have an idea of what type of home they want, the range that they're looking at, the area that they're looking at. I like starting there, and we can always move it around as obviously the conversation progresses and we figure out a little bit more about their lifestyle.
Because there's a big difference between what a bank approves someone for and what actually feels comfortable in real life, right?
Correct. What a bank approves you for is on a certain ratio. Most loans is at 50%. So what that means is 50% of your debt has to equal out to your income. So we want to make sure that your 50% debt to income ratio is comfortable. Now, that's not to say what the bank approves you for and what you are looking for matches up. So that's what we'll actually talk about, of how much you could actually qualify for, but obviously what you're comfortable with, because we don't want you in a situation where you're just making your mortgage payment and not being able to enjoy your life.
And affordability gets even more confusing when people start watching interest rates. Online, people are consistently asking things like, are mortgage rates going down? Or when will mortgage rates go down? And now I'm seeing, will mortgage rates go down in 2026 everywhere? Instead of predicting dates, can you explain what actually causes mortgage rates to move in the first place?
Another great question. Mortgage-backed securities really drive what interest rates are. So headlines, you'll see the government decreases the federal rate, which is typically the prime rate. Now, when that doesn't really affect interest rates itself, investors, how they react to that news is what drives interest rates. So when investors buy into the bond market, which they would do if they see economic decreases, so less jobs in the market, lower inflation, stuff like that, you'll see people buy into the bonds, which will drive rates down. Now, let's say that there is a low unemployment rate and higher inflation. Well, you'll see them selling bonds, which then will increase interest rates. So long story short, right now, rates are driven by investors and the mortgage-backed securities.
So when people are saying they're waiting for the perfect rate, what's the risk in that thinking?
It's very hard to time the market. So the market should be timed by you and your why.
And that leads to the next big fear I hear all the time. A lot of people say, what if I buy now and rates drop later? If that happens, what options do homeowners actually have?
When the time is right, we always have the option to change the interest rate. And what that's called is refinancing.
I think people hear the word refinance a lot, but they don't really understand it. So let's break that down clearly. So how does mortgage refinancing actually work, and when does it genuinely make sense?
So refinancing makes sense when the interest rate decreases enough from your starting rate where we can look at a cost break scenario. So what does that mean? That means on a monthly payment, how much you're going to save per month and how much you spend on a refinance. If you break even within that first 12 months, generally that would make sense. Now, obviously, it is a situational thing. So if it's something that you need and the payment savings are there, then we'll definitely do it. But we like to break it down financially to make sure that it makes sense to you for not only you, but and your family.
And when does refinancing not make sense? Because it's not automatic or free.
So refinancing doesn't make sense when the cost break isn't there. So let's say that your payments, you're saving $50 a month, but it's going to cost you $5,000 to do it. In that case, we may want to wait a little bit to see where the market shakes out. Another scenario is your rate's lower than what the current going rate is today. Now, if that's the case, obviously we don't want to put you in a worse situation. So depending on what you're looking at doing and what your goal of the refinance is, which is something that we'll talk about, that's when we'll see if it makes sense or if it does not make sense.
This conversation usually focuses on buyers, but sellers are impacted too. I work with a lot of sellers who think mortgage rates don't affect them, but they absolutely do. From your side, how do rates change buyer behavior and affordability in the market?
So when interest rates decrease, you'll see a lot more buyers go into the market. When more buyers go into the market, it drives sale prices up. Now you have more competition, people are bidding, multiple bids on homes, which is driving home prices up. So when rates are higher, you'll see less buyers in the market, which means that you may have a better chance of getting a better deal on your home. So when it comes to rates and how it affects buyers, you're looking at higher rates will actually slow the buyer side down. Lower rates will increase buyer side. So it's good to get into the house now before rates do start to decrease, which hopefully they do in 2026. And if they do, and you're already in your home, then we can go back to refinancing, what we talked about earlier.
So lower rates actually create more competition and more buyers. With all this uncertainty, if someone feels overwhelmed by rates, headlines, and predictions, what's the smartest mindset for them to have right now?
So the smartest mindset to have is knowing your why you want to buy right now, why you want to refinance right now. Again, it's always good to get into the market sooner than later because we always have that option of refinancing if the market rates do come down. So if you're ready to purchase a home, don't let rates stop you.
I think that's the biggest takeaway here. The goal isn't to time the market perfectly or wait for some magic number. It's about understanding how mortgages actually work, knowing your options, and making decisions based on your real life and not headlines. Vincent, thank you for breaking this down in a way that actually makes sense. Where can people find you?
So you can find me on all socials. Phone number is 248-388-5528, or my email, vincentnewsome@nmfunding.com.
And if you have questions about buying, selling, or how today's mortgage environment affects your situation here in Metro Detroit, be sure to download either my Home Buyer's Guide or Home Seller's Guide. You can find them on my website at leslieemartin.com, or you can find me on Instagram at leslieemartindtw. I'm Leslie Martin. I look forward to helping you make your next move.